Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of total assets. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on and look at some examples and give you a little more insight in how it's used. Total assets is the sum of current and long-term assets owned by a company. Total assets are important in determining how efficient a company is at putting its assets to use. Now let's go look at an example. To find the total assets of a company, we're going to start looking at the Walmart Stores Incorporated. You're going to look at the balance sheet of that company. Scroll on down and get to the right section here. And get out the tools. All right. What we're going to do is simply take the total current assets of that company and then add in the long-term assets as well, or the fixed assets. And below that, and you add those two figures together, you get the total assets. Okay, total assets is what we're going to be looking at today, and this is very, very important to every business because every business creates earnings based on their assets. The assets is actually what does the work for the company and makes those earnings. When you take assets and you simply add up the total of liabilities and total of the shareholders' equity, that will equal the total assets. That's why it's called a balance sheet, because it always balances. Now, whenever you're looking at total assets, like I said, it's very important because this is what's actually doing the work for you, making you money. But analysts want to know how efficient a company is with those assets. So they come up with this ratio. And this ratio is a very, very simple ratio, but it'll allow you to analyze the company looking at previous periods on the balance sheet to say, okay, is the company growing that ratio, or is it we're seeing it get squeezed, or different things you can analyze just for the company itself. But you can also compare it to the industry and individual competitors within the same industry. So we're going to give you a couple examples and let you work through it with us, and you will learn the ratio for yourself. The ratio we're going to be looking at today will be the return on total assets. This is simply, like it says right here, a measure of how a company, or how good a company is at squeezing earnings out of its assets employed in its business, which is calculated as follows. Return on assets is simply earnings before interest and taxes, that's simply EBIT or EBIT, and divided by fixed assets plus current assets. Well, we've already explained that fixed assets and long-term assets are the same thing, so you're simply taking the long-term assets and the current assets, you add them together, you're getting the actual total assets. So all we're doing is taking EBIT divided by total assets. Now, in order to get the earnings before interest and taxes, or the EBIT, we have to go to the income statement. We're looking at, again, Walmart Stores Incorporated on the income statement. We're simply going to move on down here to the right item, get out the old tools. Alright, earnings before interest and taxes, this would be EBIT. You can see it's $26.7 billion. Remember, there's this is in thousands, so you got to add three zeros to this number here. So it's $26.7 billion. We're simply going to divide that by the item found on the balance sheet, the total assets found on the balance sheet. Let's go look at the total assets. Okay, we're now back on the balance sheet for Walmart Stores Incorporated, and move on down here. Total asset figure is $193.4 billion. We'll simply plug those into our formula. Okay, first and foremost, we're going to get our formula, earnings before interest and taxes. This will be EBIT, and we'll simply take this $26.7 billion, we'll plug it in right here. The fixed assets plus the current assets is simply total assets. We'll simply take this $193.4 billion and plug it in right here. So we'll take the $26.7 billion and we'll divide it by the $193.4 billion, and this will give us a 0.13805584281. Basically, you want to simply move that decimal point 2 places over to get the percentage, and you'll get 13.81%. Very nice. Now, before we get into comparing whether or not that's good or bad for the industry or its competitors, let's actually compare it to its previous years, rather than going through some long, drawn-out, bouncing you back and forth between the balance sheet and the income statement. You can do it for yourself. I've already done the math, so I can tell you that the previous year was at 14.22%, and the year before that was 14.20%. So we've been squeezed a little bit, not substantially, as you will see when we compare it to our competitors. But that's the first thing you can do, is simply compare it to its previous history and see, are we growing that? Are we seeing it stabilize? Or are we getting squeezed by maybe a recession or more competition, different things that could be happening that could actually be seeing as those numbers squeezed. That's really not that big of a deal. From last year, 14.2 to 13.81 this year, it's not a huge drop. It's something to keep in mind whenever you're looking at companies like this. Different companies will have different capital structures. So Some companies, like if they're a people industry kind of that they're looking at, like maybe advertising, there's not a lot of assets required to run that business. It's mostly focused on just the people, and so you're going to see a lot lower total assets and a lot larger earnings before interest and taxes, and therefore you'd see a return on assets would be a lot larger. Some companies are very require a lot of assets in order to run their business models, and so you'll see a smaller return on assets in those cases. Again, you want to compare them within the industry that they're in and their own competitors within the same industry whenever you're analyzing this particular return on assets. Okay, now we're going to have a look at the company's actual competition and see how they stack up against their in competition. That's an important way to analyze a company, to see how well it's doing, and kind of helps you understand which company may be a better investment, at least from this particular ratios perspective. One of the best competitors of Walmart would be, of course, Target. So let's go ahead and take their data from the income statement. We're going to go ahead and get down here to the earnings before interest and taxes of $5.3 billion. Moving on now down to the total assets. Okay, and gets $46.6 billion. Okay, now that we have the required data for Target showing the earnings before interest and taxes of $5.3 billion, we can simply plug that in right here. And the total assets of $46.6 billion, we'll plug that in right here. And take the 5.3 divided by the 46.6 billion, and you end up with a return on assets after you move the decimal point of 11.37%. You can see, comparing Walmart's 13.8% and return on assets Target of 11.3%, that Walmart is actually more efficient than Target here, and that is another excellent point to look at. Also, when we looked at earlier, we saw that Walmart had a 14.2 a couple of years ago of return on total assets, and then it had a 14.22 last year, and then the most recent reported period we saw a 13.81. We can see that they are decreasing, yet when we also compare Target, we see basically the same thing. Actually, with Target it's a little bit more sporadic. It's got a 10.56, 12.13, and then the most current of 11.37. But you can see that Walmart effectively beats them year after year after year, and the squeezing of the margins is not just happening to Walmart, it's happening to the industry as a whole, so we don't concern us with it all that much. Okay, so that's something else you can use to analyze companies, looking at the return of total assets, and now you know. Okay, the last item I'd like to point out for you here regarding the total assets and the return on total assets. Most analysts feel that the smaller the total assets and the larger the return on total assets, the better. And that would be true, mathematically speaking. A company with a small amount of assets that produces a lot of income that could grow their business faster simply because they require less assets to do so. And basically, analysts know that the total assets are what's creating a company's income. So if you have a company that says, we want to double our income, well, they're likely going to have to do so by doubling their total assets. And so whenever you have a small amount of assets, that they feel that, okay, that company can grow faster than a company with a large amount of assets. That's true. However, there's another take on this you need to consider. Whenever you're looking at a company, let's consider a different one altogether. Let's go look at Dollar General. Okay, here we are looking at Dollar General Corporation. And scroll on down here on the balance sheet to the total assets. All right, we can see that on this particular company, reported February 3rd, 2012, they have $9.7 billion in total assets. And I've already done the math for you guys, and it's actually a 14% return there, return on total assets, which is better than Walmart's and better than Target's. However, it should be noted, when a company has a very small comparative amount of total assets, they don't have a great defense against competitors. So, for example, if someone else says, okay, we want to start off in this same sector, right now Walmart could easily, if it's, $193 billion, it could easily afford to drop $10 billion and basically create a Dollar General of their own, really just like that overnight. So there's not a great defense there. It's not a barrier of entry to other competitors there. It's not as hard, at least. Now it'd be much more difficult for some other company out there to say, hey, we want to be the next Walmart. Well, it's going to cost you $193 billion to actually duplicate what they've done. So you can see that having a large amount of assets also creates a good barrier of entry there. So if you have a good return on assets and high total assets, that's something worth considering. Don't just look at a company just because it has a return on assets that's really high and really small total assets. there should be some concern there, because that, again, won't give you that long-term advantage for a company. Okay, and now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.